Hello to everyone. Today I am going to present Credit Management and Analysis Part 2 on my channel Financial Reality. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel. Credit overview session. In this session, we are going to discuss what is credit, what is commercial credit, types of commercial credit, and types of the securities. Credit is considered the core business of the banking. Credit means granting of the loans and advances to the business enterprises and private individuals for working capital, investment, and consumption. So, it is the definition of the credit. Credit is also defined as a contractual agreement in which the borrower receives something of value today and promise to repay the lender on an agreed term and schedule. Credit can be explained as loan from the lender to the borrower. Borrower can be individual or any type of entity. Commercial credit is the process of extended credit by a bank or a department of a bank to business entities that include sole proprietor, partnership, private limited, limited companies, and governments. So commercial credit are basically purely for the purpose of meeting the business needs. Commercial credit considered to be one of the financial institution core source of revenue because on one side it's generating the revenue from the bank in the shape of financial charges, and on the other side it also playing the role to boost the economic activity within the country. Commercial credit, the business entities normally require the funds from the financial institution for the following purpose: long-term loans or fixed-term loans, short-term loans, overdraft, revolving facilities, trade facilities, hire purchase. Revolving facility means it provides number of debits and credit to the extent of the limit within the loan period. Now, first of all, we are going to discuss term loan or the fixed term loan. Facilities are to purchase the fixed asset and structure according to the customer's ability to meet the financial obligation over a fixed period with the periodic payment that can be monthly, quarterly, semi-annual, and annual. With this structure, each repayment consists of principal part and the interest part. Basically, long-term loans are normally against the capital expenditures. Capital expenditures are of two types. One of the revenue generating and other ones are non-revenue generating. Revenue generating assets include equipment and machinery. Non-revenue generating assets includes building, land, vehicles. Short-term or overdraft facilities. Overdraft facility is called the revolving facility that allow the customer multiple debits and credit as per the contractual agreement for a period of 1 year up to the credit limit sanctioned by the financial institutional authority. And overdraft is suitable for financing of working capital, overhead expenses, and seasonal purchases. Trade finance, the bank facilitate their customers both for the domestic and international trade financing, referred to be unfunded facility against letter of credit. Inland credit is letter of credit within the country. Letter of guarantee, shipping guarantee, funded facilities against term finance, syndical term finance, or term finance as per State Bank of Pakistan or any central bank schemes. Particularly, these schemes are offered to boost the export within the country according to the customer needs. Hire purchase. Industrial hire purchase is a loan guaranteed. to enable business enterprises to purchase the industrial asset for productive use. For example, assets remain legally owned by the bank so long as the hire purchase has not been fully settled. Disbursement is made directly to the vendor and hire purchase loans are granted for a period of 3 to 5 years. Now, hire purchase are basically against the marketable assets like commercial transports. On the other side, generators to meet the electricity need. Types of securities. There are other securities too. Here we are going to discuss the main four types of securities. First of all, lien, pledge, mortgage, and hypothecation. Lien, banker's lien is an enforceable right of a bank to hold in its possession any money or the property belong to a customer. Banker lien is both a possessory lien or a specific lien. So they can create the lien on physical assets like vehicles and also on the negotiable instrument. Pledge defined as bailment of the goods as protection for the payment of a money owing or act of a promise. Borrower is called a pledger and the banker is called the pledger. The contractive delivery is made when the bailee bank put his lock on the doors of the godam storing the pledged goods. It is essential that the bailee should return the same goods to the bailer after receiving the payment as per agreed terms. So here the lock and key is with the bank, and with the settlement of the loan uh, amount the bank used to release their goods accordingly. Mortgage, mortgage and other type of the securities which can be defined as mortgage is a reassigning of interest in particular fixed property for a reason of protection of payment of the fund advanced by means of the loan, a presenting of the future balance due, or act of the commitment which may be rise to a financial liability. Transferor may be known as the mortgager and the transferee may be known as the mortgagee. The contract is treated as mortgage deed. So it is one of the very effective type of the securities to secure the bank's loans. Hypothecation is the type of the security defined as a lawful transaction, and essential goods are always accessible as security for a balance due without transferring either the property or the possession of the lender. Possession and the ownership of the good remain with the borrower, and an equitable charge is created in favor of the lender. Means all the hypothetic assets remain in the possession and the use of the customer, but bank can anytime assess those assets availability with the customer. Thank you very much. See you with my new video on credit management and analysis very soon.